Hello and welcome to Trading Growth and Value Stocks. My name is James Boyd. We welcome you here today. And I want to just verify just real quick. Yep, it's what I'd like to do first off is welcome all of you here. Also, we have birthday boy with us as well, Gary Taylor. Give a quick shout out to Gary for his 29th birthday. Happy birthday to you. Happy 29, Gary, and many more to come. All right. Hello, BJ, B Hall, Jay Richardson, WW, JP, GH, and many others. Barat, hello to you. Now, just real quick as we get going here, we also have Ben Watson in the chat. You'll see his initials, BW, there. You can follow him and myself right on X as we do post educational announcements and also educational examples. Now, just real quick as we're getting started here, remember the information here is provided for general informational purposes only, should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Also, remember that Schwab does not recommend the use of technical analysis as a sole means of research. Nice thing about having different classes is you really learn different skill sets, and the goal is how to bring those skill sets together, okay? And also remember when we talk about examples, we will do those on the Paper Money software application. If you're brand new here for the first time, we welcome you, and just know that this is being recorded, and I'll show you where you can find that recording. Also, when we talk about if we do bring up stocks that pay dividends, realize that there is risk to dividends. They may reduce or stop paying dividends, okay? So just understand it's not like a treasury bill, okay? It can be dependent upon the board's decision and also the profitability and the financial current status or the future status of what they think that company could do financially. So that dividend could change, positive or negative. And also remember that investing involves risk. You are in the business of risk. You manage risk. We evaluate reward and risk. And so risk is really big, as we talked about last week. Now, also just real quick as we get going here, go to schwab.com, okay, /events. We have in-person events. Ben Watson and others teach at those. And the next one we'll do is in Anaheim. It's a 2-day event. It's on advanced options. So anyone that's a Schwab client can go to that page right there that I'm pointing to and sign up. There is limited seating. So it's not like 20,000 people. There is a certain capacity. Once it's filled to capacity, they do say, hey, you're going to have to wait till next time. So we do put that schedule out for the entire year, and you'll see that right on that website. If you're actually on the East Coast, by the way, you don't have to be living in that area. You could be in that area for work, family, travel, and so on. We'll also be at the Miami Market Drive, which is a 1-day event, and also the New York Market Drive as well. So kind of coast to coast here as Ben just flies to the moon. Okay, and he does a great job, okay? And if you've ever followed him on his X page, you'll know what I mean. So let's just real quick get started. So also remember, and I'll show you some other things on the website in just a moment. So first off is I want to talk about the market just real quick. Lisa asked a question regarding the VIX. I'll bring that up as we talk about market and sectors. As we talk about market and sectors, I want to emphasize kind of understanding trend for a moment, okay, which is really big. I think it took me probably 10 years just to really understand trend. And I don't know why it took so long, but I think sometimes is we need to revisit how trends typically work and why every day is not just an explosion. And sometimes is that a good thing, okay? Now, also we'll talk about new examples, and I want to focus on really buying in pauses. I want to talk about buy stops. I want to talk about breakouts in the shorter term and kind of looking for some stocks that haven't made maybe the move yet, but are maybe starting to break out. So that's going to be a focus of ours here today. So first off, what I want to do here is I'm just going to go ahead and just bring up, let's just bring up the broad market, the good old SPX, okay? Now, what you're now going to notice is on this chart, and this is the chart we've been using for weeks here, we got above the 100%. So if some of you are saying, I've never seen anything like that, what is that? It's a Fibonacci retracements, okay? I'm just going to leave it here just because it's been a marker of ours, and I don't want to delete that. And the white horizontal line is what you'd expect. It's the old support, the new potential resistance. Now, I want to zoom in for just a moment on this. Now, can anybody remind me, when we get a breakout, what day of the breakout tends to be the high, maybe before a pullback? Is it day 1? Is it day 2? Is it day 3? What day tends to be the high before you get a little pullback and maybe perhaps a little retest? If it does, well, it's usually the second day that actually is. So if we looked at this and said, hey, let's hypothetically say that was the breakout day, today we kind of had a red candle. And so the answer to the question is, it's usually the second day that's the high. And then after you make that high, typically you get a pullback, okay? Now, in the pullback, if we start to get candles where the body of the candle is thin, meaning the open and the close are about the same level, would that be a bad sign? That's a question. If we start seeing red candles where the bodies of the candles were very thin, is that a good or a bad sign? Well, I think many technicians might say, James, I'll take that all day long, because we have really neutrality between buyers and sellers. Sellers are not being able to push it down below support. Now, someone who's impatient would probably just want the stock to shoot up, in this case, the SPX, to shoot up to the top of the channel. It's not saying it can't do that. But the biggest actually thing is sometimes you need pauses to create higher lows and new support levels. The pullback is a part of the uptrend. The higher high, it's a higher high. The pullback is in the process of the evolution, if you will, of making the higher low. You don't get higher lows typically without red candles. You need red candles, pullback days, to make the higher lows. You make the higher high and the higher low, you actually get the higher high. Now, if someone said a comment like, well, today it just did nothing. Well, actually, that's not, you could actually say, I mean, point-wise, that's true, but actually, you could also say is that, wow, after shooting to the upside from Monday and Tuesday, if sellers were here, they couldn't really push the market down a whole lot, which is just another indication of momentum and sentiment. Okay, so don't think that every day is going to be a 1,000-point rip on the Dow just because I want it to be. We have to be mature enough where we understand that higher lows are formed from red candles. Now, we talked about that at length. If we don't get red candles, if we don't get a pullback of red candles longer than 3 days, strong momentum. If we actually, let's say, the bodies of the candles are very thin, we're not really seeing sellers take control. Buyers are buying into the dip. Don't worry, we're going to focus on it in just a sec. So someone who doesn't probably understand is going to look at the red candle and say, weakness, maybe this is a sign of failure here. Couldn't be farther from the truth, okay? Now, if we take a look at this, I want to also go back to the VIX for just a moment, okay? When you take a look at the VIX, let me bring up the MACD. The MACD that I'm going to use, there was a question from Lisa regarding the MACD, and the purpose of really bringing this chart up is we want to kind of have an understanding, and if you don't mind, I'm going to use so on the MACD histogram, we really have 3 different settings, okay? A 6-13-9 setting, which is very sensitive, hence the number of days are less. We have an 8-17-9, think of that as medium. And then you also have a 12-26-9, which is like lagging, okay? In other words, higher the numbers, you really want more days to confirm. So if you said, James, I'm a short-term trader, like 2 to 3 days to 2-3 weeks, you might like a 6-13-9. If you said, James, I'm kind of more 2-3 weeks to 2-3 months, you might like the 8-17-9, okay? And if you ever ask 12-26-9, that's probably the longer-term investor who's maybe looking at things on a monthly or quarterly basis. It's not how we look at it, so I don't bring it up or show it very much. Now what I'm going to do is going to come back. Now the question from Lisa was, Are we seeing a divergence on this chart? And why do we even care? Well, the biggest thing is when we've seen market reversals, there has really been some signs of the MACD being at the lowest point, then the MACD actually not falling down as low again, and then what we actually see on this chart is the MACD is not as low. We're still below zero, but what you're seeing is the troughs, they're not getting lower, they're actually getting higher. So the red bars, they're actually saying the histogram is below the zero and it's worse than the previous day or lower than the previous day. The burgundy bar, meaning the histogram is below zero, but it's improved. The momentum or the momentum has improved from the previous day. That's why the color differences. Now, here's my comment on the VIX. So let me ask you a question, okay? If we see a VIX divergence, okay, and by the way, to get a divergence, we need a price level to drop and we need the oscillator to go the opposite direction. So if I actually kind of said, is Lisa right in saying that there's a divergence? I would say she's right, okay? So what would the investor be thinking about if the VIX was diverging? A, fully investing in a new portfolio for the short term? Maybe not, okay? Might the investor be saying, James, I'm going to be looking for, let's say, targets. Let's write this one down here. They're probably watching targets, okay? How close am I to the targets? Now, if you're getting close to the targets, you might say, James, I'm going to probably consider maybe adjusting stops, okay? This is probably not for some stocks where the investor sits back and calls 10 buddies and tells those 10 friends how smart they are, that they've been riding this trend to the upside. And let me tell you how smart I am. Hopefully you didn't make those phone calls, okay? That wouldn't be nice. Always be humble, that's important, okay? Be like Ben. Now, the biggest actually thing is when we talk about this, some investors might consider derivatives. Now, I'm not even gonna go into that. But when we talk about that, the investor might change the sensitivity to direction based on that if this continues and we start to go up, that volatility is increasing. Remember, when volatility increases, where does the trend typically go? The trend typically goes down. So that's why investors watch that. Now, you might be really surprised at my comment now. Now, it's plausible that VIX goes up, but we're going to say that there's probably a pretty high chance that the VIX could actually go up a little bit, perhaps. We've talked about that at length, but maybe the SPX and the MDX, maybe in the Dow, okay, test the high. Oh my gosh, I can't believe what you just said. Now let me go back to the chart. Let's go back to the NDX just real quick. How far are we from that top? Now, if we take a look at this and kind of say, so James, what do we mean by that comment? What I'm saying is we're not that far off the prior high. If we're talking about doing a class called swing trading or trading growth and value stocks, as short-term traders, we know that those short-term traders are probably going to say, look, James, if we come up to the 21,817, I'm going to sell into strength, that investor says. I'm going to back the truck up and sell, because that's what they're trained to do, right? They're trained to, hey, see the resistance and sell into the strength. Now, that kind of begs the question, is everything in the portfolio a short-term trade? Everything? And that's where we got to be like honest with ourselves and say, well, not everything is a short-term trade. I'd like to hold on to some positions that are maybe more intermediate to longer term, but there could be some opportunity there. So my comment back to Lisa and everyone is, what's the chances that maybe we go back up to 21,817, or maybe what's the chances that we actually go back up to, let's say, 22,198? The answer, probably pretty high. Could it also go up to that and the VIX rises as the NASDAQ does? That could be plausible, as people are saying, look, instead of actually just setting stops, they're going to buy the right to sell. So That's something to kind of keep an eye on. Now, on Monday, I talked about what might cause some breakouts to occur. What are some key components that might cause breakout levels to happen? Okay, or stocks to get above resistance. We hit that aggressively. When you take a look at what we've seen as of lately, we saw a gap up in the price, went up again yesterday, today gapped up and rallied up again. If we look at this, what's the path of least resistance? The path of least resistance is we break inside the channel, which we've done, and then we try to go to the top of the channel. Now, just the other day, we talked about NVIDIA, which we're going to now talk about, new trade examples. We talked about that stock getting above 118, took a long position. When I say a long position, we talk about we bought the shares, right? It breaks out. Path of least resistance is what? To go to the next horizontal channel. So here's the deal for just a second, okay? Someone on the flip side of this could have said, bearish divergence, bad sign. If we said between a bullish divergence and a bearish divergence, is there one that's probably less significant? The answer is the bearish divergence. When the price goes up and that oscillator is shrinking down, that's why we don't talk about it as much. The bullish divergence, which we talked about on the VIX, that is something to watch for sure. It's not saying at that exact moment it's going to crash the market. It's just saying we're kind of reaching a point of bullish fatigue, okay? But I think, as I mentioned, as a class here, could there be some chances that the market goes up to those prior highs, which were not that far off? And if we kind of agreed as a class, let's say we think potentially there's a pretty good chance. Now, what you're now going to notice is I want to kind of start with just real quick NVIDIA to begin with. Now, I got a number of stocks in our focus in just a sec, so I want to go back and see if there's any questions, okay? Now, Lisa asked the question, does anyone look at a bearish divergence? You know, I mean, I think you can look at them, but they just don't tend to, it doesn't seem like I kind of compared it when you're going up the hill. Let's say you're riding a bike, right? You're riding a bike up the hill, and you know, at the first push, that first hill right there, in step one, man, you're amazing. You're like Lance Armstrong going up the hill. And then, for example, the second one, you're like Puff the Magic Dragon. You're like breathing so hard. And that third one, you're just like, look, maybe call the ambulance. I'm not sure if I'm going to make it. And I'm talking about it if you live in Utah or Colorado or something like that. But the biggest actually thing is what it's going to do is price is going to be going up, but the momentum is going to be going the opposite direction. That's how I kind of think about a bearish MACD divergence, okay? Because the price goes up, the momentum normally goes down. Now, what's abnormal, though, is when you see that snap to the upside like we actually saw in NVIDIA. Now, I could make a statement like, oh, we missed the breakout. It's gone too high. Now, you know that those are the words that get underneath my skin. Oh, don't say those words. Okay, now, let's have a little fun here. Now, what I want to do, let's say the investor said, you know what, James, the stock, I wish I would have bought right here, but my friend talked me out of it. James, I wish I would have bought right here, but the gap scared me. I didn't know what the gap meant, even though we talked about examples and giving understanding what that is, how it happens, and so on. I didn't buy here because the stock was at resistance, and I thought we could never go above that level. Then I saw the stock gap to the upside, and that gap scared me again, even though that just probably means there's more buyers than sellers at the open of the market. It's not guaranteed that the stock's going to close higher, but it's just showing buyers stepping up to buy again. Now, let's kind of imagine the investor said, okay, I've learned from my past, okay? Next time I see that happen, I'm going to trade my plan, okay? Now, let's say the investor says, James, I'm going to try to buy a little bit of a dip. Now, this class is trading growth and value, okay? Now, what I want to do first off is one of the first things we know as retail buyers, we like to buy cheap. Now, be very careful with that. This is not trying to buy hamburger for $2.95 a pound, okay? And then thinking, man, that was a great deal. That's not what we're talking about here. We're talking about investing, okay? Not spending, okay? So the biggest actually thing is we're going to try to set a buy limit order off the horizontal line. Now, if we did this, if someone said, James, I got the horizontal line. If I did 1% above that line, it's 130. If I did 2% above that line, it's about 130, 180. If I did 3% above that line, it's right around 133.01. Now, some investors, they might feel uncomfortable to buy any more than 3% off support. Now, let's logically think through this. If they buy 3% off support, and then they set a stop 2% below the support, 3% above, 2% below, that means their forecasted risk is about 5%. All right, that's what it is. Now, does that guarantee that if it goes down to that price, it's guaranteed to sell out? No. Stop is not a guarantee. Stop is an order to sell, okay? But we don't know what the fill is going to be. Now, what we're going to do, now a lot of times when the prices shoot up to the upside like this, a lot of times people don't use the orders. They're wanting to hear information that validates their indecision. Let me repeat what I just said. They're wanting to hear information that validates their indecision. Now, remember I said to you before, what is investing? Investing is really math and psychology, okay? Now, what I'm going to do is I'm going to right-click on this chart. I'm going to go to Buy Custom. I'm going to go with the OCO bracket. Now, what I'm going to do on this order is we're going to use example given. Now, I want to make sure that I pull this up in that right, so I'm going to do it in the paper money account. And let me just go back to this. I'm going to put about 133, which is exactly where we had. Right-click there, Buy Custom with OCO bracket, okay? I'm in the paper money account. And so this is what's kind of nice is when we talk about examples, we're going to follow through with them in the paper money account. Everyone, I don't know about everyone, okay, but the majority of them, okay? Now, what I'm going to do in this case is we got to order to buy. Now, our capital size, which we had a class last week on capital size and position sizing, etc., we're going to take a capital size of $6,000. If we had $100,000-ish portfolio and we buy $6,000 worth, it's about 6% of the portfolio in terms of capital size. It's going to really give us about 45 shares of stock. Now, when we actually go back and kind of look at the target, that target was 143.54. Okay, so I'm going to put 143. We don't have to put right at 143.5. I'm just going to kind of put a little shy. Now, the reason why I like to kind of put it a little shy is some investors, they might like to get out a little early, then set a target too high that doesn't exactly quite go there. They would rather kind of be a little bit more conservative than aggressive and not get a fill. That's the idea of putting a little lower. Now, the stop underneath, which we talked about, that stop underneath is about 126 flat. And now here you go right here. Now, there's a lot of discussion sometimes on, hey, James, your reward to risk. I've told you many times, okay? Reward to risk is kind of more fabrication on where you set stops and how you set the targets. So it's kind of like you can kind of make yourself feel good on where you set those targets and the stops. What I've learned over time is historically, I would say, man, I want a tight stop, but then I realized, well, I said tight stops, I get stopped out a lot. I get stomped out a lot. That actually means realized losses. So what I learned over time is, hey, wonder if the investor gave a little bit more. And why did you set tight stop losses? Well, because I was trying to have a good reward risk ratio. But then I realized when I did that, I was extremely successful in getting stopped out. So then I said, well, let's practice maybe setting that stop a little looser. But the reward risk ratio is not as favorable. And the goal of the investors is to try to really not realize the loss. It's to try to get to the potential target and get the trade off the ground. All right. Now, 143 target. If we went to the upside, about $10. That's if it went there. Now, if it goes down to the stop, we're talking about $7. If you said, what does that mean to me? Absolutely nothing. Okay? What means a lot more to me is what is the market doing? What means a lot more to me is what the sector is doing. What means a lot more to me is what is the industry group doing. And the last point is, what is the company doing? That has a lot more relevancy to what the reward risk ratio is. Ask me how I feel, okay? Now, if we take a look at this, what I'm gonna do is we're gonna send this in the IRA account. We're gonna go to confirm and send, and now we see the order. Now, how do you really learn about investing? Look, it's gonna be tough to learn it in the bleachers, okay? We give you the paper money account to practice, and so what it does is this is not real money, it's simulated, it's paper trading, and what you're now gonna notice is it's 45 shares of stock. Notice it also says with the stop order, there's no guarantee the execution price, what it fills at, will be equal to or near the activation price, okay? Now, what I'm gonna do is I'm gonna send that order, okay? And I'll fix that. But the biggest, and sometimes on my paper money account it does that, but we're gonna buy 45 shares of stock. And the goal that I wanna actually also kind of make mention of as I kind of saw that order is, on that limit order, one thing I wanna bring out is that you might consider in the paper money account is if we just did it for a day order, it would just be good for the day. We might say, look, we're gonna do a GTC order, okay? Might do a GTC order, okay? Good till canceled. If you said, James, I don't like that order just standing out there indefinitely, maybe up to 6 months, maybe you said, James, I'll give this trade a week. And what you can do is say, look, I'll give this trade a week if it can go down to that price or less. And what I'm gonna say is cancel this order at a specified time. I'll give it a week. If it can pull back to that threshold and get in, I'll allow it a week. At the end of the week, if it can't do that, cancel the order, okay? Now, the one thing is this right here, this order is commitment. In other words, if it goes down to the price of the 133, buy at that price or less. Now, sometimes what people will say is, hey, set the alert. The problem is sometimes when the alert goes off, then the investor says, I'm not sure if I want to buy. And sometimes it's deer in the headlights. So sometimes having a mixture of actual orders and alerts might make sense than just having a whole bunch of alerts, okay? Now, I want to go back to kind of one of the points I want to bring up here and practice this type of setup for just a moment, okay? Now, one of the stock I want to bring up is this one, okay? Apple, okay? Now, if you take a look at Apple, we would actually say, look, Apple maybe has underperformed to some degree compared to the S&P 500. And if we look at this, and if I were to kind of draw like a line, okay, you're gonna see that we have a diagonal line, maybe like right there. We also maybe have like a diagonal line there, okay? And some of you give me a nickname, James Body to Body Boyd, okay? And James Diagonal Boyd, some of you have kind of called that. My middle name's Sterling, but sure, okay? So what we actually see yesterday, 2 days ago, is it gapped to the upside and it had a red candle. The very next day, we had a bullish engulfing candle. Now today, an investor might say, yeah, this didn't do anything. Be careful of that. You just fallen for the trap. You've been brainwashed, okay? That red candle is significant, even though that body did nothing. The fact that the stock was able to stay above the resistance is important because if sellers were going to sell, they could have whacked this thing to the downside here today, and they couldn't flush it down, and that's big. Now, the investor might say, well, I'm going to wait and see what happens. Well, what we want to impress upon your mind is using orders. Now, in this type of setup, the investor might say, you know what, James, I'm going to take the most recent red candle, which, by the way, is today. Now, I'm going to tell you with what I'm talking about right now, I don't care if you've been investing for 5, 10, 15, 20, 25, 35, 40 years, it doesn't matter. The biggest thing is, what are we applying? And so what we're going to do is we're going to say, look, that was a breakout 2 days ago, per the definition of the breakout we talked about. Second, we actually see a red candle. And the investor might say, the question that gets asked is, what would the investor want to see to consider a bullish entry? Well, a technician might say, well, James, I want to see that stock really get above the high of the low day. It's easy definitions. What is the low day? Well, look at the lowest, most recent red candles. If there was only one red candle so far, then we're looking at today. Second, what is the high of that red candle? And it's 213.94. Okay, now what? Well, what we're going to do is we're going to set a little buy stop at that price or higher. Okay, now here's the deal. This is where we're now kind of taking what we've learned and then practicing attacking the stock instead of saying, I missed another one. I missed another one. I could have done this. I could have. Look, the bottom line is the orders weren't set up. Imagine if you would have just practiced in the paper money account, hypothetically, a bunch of buy stops in the last 2 weeks. Could they have worked? Sure. Could they have maybe not worked? Yeah, sure. It doesn't mean they're always going to work, but the investor is trying to really catch the potential thrust in the price. Okay. Now, what I'm going to do is I'm going to right click on this line. Now, this goes against everything that someone usually lives in their life. Like, why would I want to buy it at a higher price? Well, you're really saying I'm willing to buy it at a higher price because you're trying to say, look, that stock might be breaking out to the upside. Now, what I'm going to do is I'm going to put that buy order at 214.14. 20 cents above that high. We've done that for years, okay? But if you take a look at that, 20 cents above that high, that's what it is. And it's saying, look, buy the stock if it gets to that price or higher. Now, I know how some of you feel about this. You're like, I would never do that. And I just don't like doing that because I don't know what I'm going to buy it for. Fine, I'm with you. Go to stop limit. And what I'm going to do is I'm going to place a cap. You can't buy it any higher than 215.14. So you're allowed only buy the stock if it gets to that price or higher. And here's the cap of what we're willing to buy it for. Does that make you feel better? Okay, good. Now we're feeling better. Okay. Now, so this is a classic buy stop. Now, what we're trying to focus on is what have been some stocks that have maybe broken out lately and they've had in the last day or two red candles. Thought process? Well, the thought process is these might be the pause days before we piercing line back to the upside, before we bullish engulfing back to the upside, before we go hammer time back to the upside. If it does, we don't know if it is. Now, what I'm going to do is I'm going to back this off and say, look, if it were to go back to the upside, tell me where you see resistance. Well, that resistance, okay, that resistance is probably in the ballpark about 247. And some of you Samsung users out there, you're like, I'm never going to give a 247 price target. I'm only going 236, says the Samsung user. Now, some of you might say, look, I'm even less than that. I didn't think it could go up that high. These are some areas where some technicians might set targets. Now, it's kind of funny because do all investors set the same targets? Of course not. Okay? That's why if the stock did go up to 228, the stock doesn't just collapse. Because a lot of times the price is maybe where investors are trying to sell at different price levels. And they might be moving up their stops just over time. So I'm going to put this, I'm going to act like this paper money account is a Samsung user and doesn't want to see Apple go up higher. That's a joke. Just laugh for once. Okay? GTC. Now, what we're going to do is I'm going to set this stop underneath the diagonal line. Okay? I'm glad to see some of you laughing. Okay? 208.45. Okay, here we go. 208.45 less 2%. Okay? Now, by the way, if you didn't see that class from last week, I'm going to put in the playlist in just a sec, something I want you to watch just to make sure you hammer down. Because here's the thing, you could have the trends going straight up, but it doesn't matter if the investor's not in, okay? And the number one thing that stops the investor to get in is they're not comfortable with position sizing. The second reason why they're not comfortable is they don't know what they're actually buying. Welcome to fundamentals. Now, the biggest actually thing is 204.28. We're going to put that right there, 204.28, okay? Now, one of the things I want you to practice, okay? I want you in the paper money account to practice this Apple position. It's an example, it's not a recommendation, but I want you to practice with this class, okay? So that way we can kind of follow through on it. Now, what I'm going to do in terms of the position sizing, I'm going to go back and just put that $6,000 position size we talked about from last week to this week, and there it is. It's going to be about 27 shares of stock, okay? Now, let me bring something up to you for just a moment if I can. One thing I want to do just real quick, let me slide this over, and I don't like the, I want to bring up something just real quick, and I know I'm talking sideways. There it is, okay? All right, now, this right here is a playlist from this class. So do not think if this is your first time here, you say this is a one-off class. It's not. So this link that I'm sending to you is a playlist that, for example, that we have. And last week we talked about right there, the enemy could be you. No position sizing. Now, the reason why I chose Apple is if you kind of listen to kind of how people were talking about 2 weeks ago, you would have thought the end of the world was nigh at hand, literally. And for example, that there was going to be nothing on the shelves, period. And you know exactly what I'm talking about, okay? And it's just interesting, okay? Now, if we were to go to IXY, which is the consumer discretionary sector, that has been a space that's had a nice breakout. Now, again, if you can count to 3, which all of us can, okay? Just making sure we're all crystal clear. If we only get 1 day pullback, only to see the price go green again, bullish momentum. If we only see 2 day of red candles, only to see green candles reappear, bullish momentum. Yeah, but James, wonder if you don't get 3 red days. The trend is stronger than you think it is. Now, at that point, you might be thinking, yeah, but my feelings, my thoughts, that doesn't matter. That's not technical analysis, okay? Now, if we take a look, let's say the technology, we could say that Apple could be in both sectors. I mean, you don't have to have an iPad Pro. You don't have to have an iPad. You don't have to have an iPhone, a watch. You don't have to have the MacBook Pro and the Air. I'm not saying anything about myself, but I'm just saying you could say there's some technology, but there is some discretionary in it as well. I mean, you could maybe just have a Asus laptop for $300. You don't have to buy a good one, like a MacBook or something like that, hypothetically. Now, if we take a look at this, notice that if we look at, let's say, technology, the sector, it's already halfway through. Now, this is going to be something that we're going to be keeping an eye on, okay? When we look at the sector, which we talked about on Friday with Kevin and I, about a product where you can buy a basket of stocks, we haven't even had a pullback to where the breakout happened. Now, Lisa, we're going to watch the VIX, okay? But if we're seeing on some of these sectors like technology, consumer discretionary, and communications, if we're not really seeing even retest of where we broke out through, then the path of least resistance might be up to the top, meaning that some of those technicians might be trying to move up their targets, okay, thinking that price might drift a little higher. Now, Kevin asked me about kind of what do I think about the RSI and the market, and I told him I'm not even looking at the RSI, okay? Some of the most deadliest markets I've ever seen in 25 years are the ones that slowly drift higher on low volatility, okay? And this market, especially in the last 2 weeks, has reminded me of a little grind higher. Now, what I want to do is I also want to go back to another one just real quick, is BlackRock, okay? Now, this is going to be the second example I want us to practice trade together. Now, this one I'm going to do a little faster, okay? Now, notice it's right at this key level. Now, this chart is going to look very similar to many, many, many other charts that we've seen in the marketplace. It's right here. Now, James, you might be thinking, well, how do I find the stock? You won't believe it. We have that script called the 20-day high, and this is at the 20-day high. Sometimes the 20-day high could actually be right near or at resistance or at a brand new high. Now, what you're now going to notice is something that we taught last week, which is why would a stock be making a higher low right in an area of resistance if someone who bought today didn't think it was going to go higher? Now, I'm going to kind of mark on the chart some areas. 981, another area, 1018, and also 1066. Now, if you're looking at kind of the first target and saying, well, James, I'm going to target 988, that's not a whole lot of upside if we're talking about we're just getting in now. We're zooming in on this right-hand side right here so we can see this. And what you're going to see is over the last 2 days, the bodies of the candles have been quite thin. If people have been selling this, it's just not very much at all. They can't even push it down. They can't even get the price to come down to the moving average because the stock price is acting like a hot air balloon, okay? And all of a sudden, it's not a close above the high of the low day yet, but it is what we call a trigger day. The trigger day is when the stock is an up day, hence a green candle, but we're not above, and actually I take that back, wash my mouth out with soap. I was looking at this day as the low day, denied, and what you're now going to see is that day is the lowest most recent red candle if we're just talking about in the last 3 days. Now the reason why you're seeing the green dot is saying, hello, James, okay? Now scripts are not guaranteed for accuracy or timing. Verify, have an understanding of what they're trying to tell you. And what you're now seeing is we're above that high, especially in the last 2-3 days. Now, what I'm going to do is I'm going to right click on this chart, go buy custom with OCO bracket. So paper trade example that we did, number one was Apple. Second one we're actually doing is BlackRock. And you might be wondering, and probably ask yourself is, what does BlackRock own? What might cause that to actually go up in value? Now I'm going to put 118, and then what I'm going to do is underneath, for a stop, I'm going to use that 10-day whole moving average as a potential support area, okay? And I'm going to set the stop less 2%. Now, what I'm going to do is 935.30, and I'm going to put it right here, okay? Now, you might be thinking to yourself, well, where could someone see the fundamentals of the business, okay? And if we went to, for example, where it says analyze, we could go right to where it says fundamentals. Now, if we're an investor, if you're literally buying a business, et cetera, or buying shares in stock, you're probably interested in knowing, A, what do they actually do? Second, you're probably interested in terms of like some valuation, some share values, we should call it, like sales per share, which is just the revenue divided by the shares outstanding. And some investors want to really see over time that these numbers are improving, meaning they're able to sell more and they're also able to capitalize on the sales by bringing not just selling something, but there's actually earnings after those sales. And they like to see those numbers on top increase over time as well. Now, we're not saying they're always going to, if they're doing that, it's guaranteed to go up. This is just showing, like on the chart, the price chart shows a price history. Doesn't mean it's going to go up tomorrow. And the same thing with fundamentals. Just because we're seeing numerical numbers predominantly actually go up, it doesn't mean that they're always going to be going up in the future or guarantees an expected return, okay? But there's been a recent trend. Now, in closing this out here, what I'm going to do is got 935.30 stop, 1018 target price, and also 967, okay? Now, what I'm going to do is, on a homework assignment, I also want to give, so we talk about Apple, paper trade that, it's not a recommendation, but I want you to follow along. Second, we did BlackRock. Can you practice alongside us? The third one I want you to practice all on your own is QCOM, okay? And QCOM looks like as follows, and this is going to be all on you, okay? And it looks very much just like the one we looked at, and it says this very sensitive area of what we call resistance. And I want you to practice putting those targets at the next horizontal resistance or diagonal resistance. Okay, so 3 trades, Apple. Okay, second one, we actually talked about BlackRock. Third one we're actually bringing up, last one is QCOM. So next week we'll swing back and we'll talk about these 3 trade setups. And I also want to give us a quick reminder that you can also go to our YouTube page, okay? So you can go to YouTube, and this is our Trader Talks channel. And what you're now going to see is you can subscribe for free and actually get all of our content. Last point is you can also go to schwab.com/coaching, and you can also see all of our live webcasts and also upcoming webcasts as well. Join us back tomorrow with Trader Talks in today's trading market tomorrow morning, right at 9:30 a.m. Eastern. I'm out of my time here today. Thank you, Ben Watson, for answering those questions in chat. And also remember, with what we discussed, it was done for example, illustrative purposes only. This has been the example of you trading growth and value stocks. Today, more of a growth focus and talking about timing of these bullish setups. Thanks so much. Take care. Bye-bye.